Hello and welcome to our channel, where we demystify the stock market for you. We're about to embark on an intriguing journey into the realm of options trading in the Indian stock market. This comprehensive guide will take you through the basics, the ins and outs, and provide you with the tools you need to navigate this exciting financial landscape. So whether you're a novice or just looking to hone your skills, this video is for you. Options are financial derivatives that give you the right, but not the obligation, to buy or sell an asset at a predetermined price, on or before a certain date. Now let's break this down a bit. Picture a marketplace where traders deal not just in stocks, but in possibilities. That's exactly what options trading is all about. Imagine you're eyeing a stock. Instead of buying it outright, you can purchase a call option. This gives you the right, but not the obligation, to buy the stock at a set price. You're essentially betting that the stock price will rise. On the flip side, a put option gives you the right to sell a stock at a set price. You're betting on the stock price to fall. Both calls and puts offer a way to speculate on stock price movement without actually owning the stock. They come in two main types, calls and puts. Options can be used for hedging, which means protecting your investments from market downsides. They offer a level of security by locking in a price where a stock can be bought or sold, regardless of how the market fluctuates. This ability to hedge against potential losses makes options a valuable tool for many investors. Additionally, options are often used for speculation. Traders can use options to profit from stock price movements without actually owning the stock. This can provide a substantial return on investment if the trader's speculation proves correct. But let's not forget the other side of the coin. While the potential for profit is enticing, options trading is not without its risks. These can include losing the entire investment if the market doesn't move in the anticipated direction. Furthermore, options trading is complex, requiring a deep understanding of financial markets and trading strategies. However, options trading involves significant risks and is not suitable for all investors. It's important to fully understand how they work before diving in. In India, options are traded on platforms like the National Stock Exchange, often referred to as the NSE, and the Bombay Stock Exchange, or BSE for short. These exchanges serve as the marketplace where buyers and sellers come together to trade options contracts. To get started with options trading, you'll need two things: a Demat account and a trading account. Your Demat account holds your shares and securities in a dematerialized or digital format. On the other hand, your trading account is what you'll use to buy and sell securities in the stock market. Once you've set up these accounts, you're ready to start trading. But hold on, to make informed trading decisions, you'll need to understand how options prices or premiums are determined. You see, several factors influence the price of an options contract. The first two are the current stock price and the strike price of the option. If the stock price is far from the strike price, the premium will be lower. As they get closer, the premium increases. Then we have volatility. If the stock price is fluctuating wildly, the premium will be higher to account for the increased risk. Time to expiration also plays a role. As the expiration date approaches, the premium typically decreases, a phenomenon known as time decay. Lastly, interest rates can impact options prices, although their effect is less direct and more complex. Options prices, also known as premiums, are influenced by factors like the stock price, strike price, volatility, time to expiration, and interest rates. This is the price at which you can buy or call or sell or put the underlying stock. Now, let's break that down. In the world of options trading, this is referred to as the strike price. It's a fixed amount agreed upon at the inception of the contract. If you're dealing with a call option, the strike price is the rate at which you can buy the stock. If it's a put option, it's where you can sell it. Now, on to expiry. Every option contract comes with an expiration date. This is the final date by which the option must be exercised. If it isn't, it simply becomes worthless. It's a bit like a ticking clock, counting down to the moment of truth. In India, The expiry of options contracts typically falls on the last Thursday of the month. So in essence, strike price and expiry are two fundamental concepts in options trading, defining the terms of your potential transaction. Remember, options have an expiration date. This is when the option must be exercised or it becomes worthless. In India, expiry is typically on the last Thursday of the month. Let's cover two basic strategies: buying calls and buying puts. Buying a call option is essentially placing a bet that a particular stock's price will rise. You're purchasing the right, but not the obligation, to buy a stock at a predetermined price, known as the strike price. If the stock's price rises above this strike price, you can exercise your option to buy the stock and immediately sell it for a profit. On the other hand, buying a put option is a wager that a stock's price will fall. You're buying the right to sell a stock at a predetermined price. If the stock's price falls below the strike price, you can exercise your option to sell the stock, potentially making a profit from the drop in price. But what if you're not a beginner? What if you're a seasoned trader looking for a bit more sophistication in your strategies? Well, there are more advanced strategies available to you, like iron condors and butterflies. These strategies involve trading multiple options simultaneously, and they're designed to capitalize on market movements while managing risk. An iron condor, for instance, is a strategy that involves buying and selling 4 different options with different strike prices. The goal is to profit from low volatility in the market. Basically, you're betting that the stock price will stay within a certain range. On the flip side, a butterfly strategy involves buying and selling 3 different options with 3 different strike prices. The aim is to profit from low volatility, much like the iron condor, but with a different payoff structure. You're essentially betting that the stock price will stay close to the middle strike price. So, whether you're a beginner or a seasoned trader, options trading offers a range of strategies to suit your risk tolerance and market outlook, from the straightforward buying of calls and puts to the more intricate iron condors and butterflies. There's a strategy for everyone. For the more advanced traders, there are strategies like iron condors and butterflies. These involve multiple options to capitalize on market movements while managing risk. Options are highly volatile and can lead to substantial gains or losses. This sentence isn't just a casual observation, it's a fundamental principle of options trading. The volatility in options trading refers to the rate at which the price of an option increases or decreases for a set of returns. Options are more volatile than traditional shares because they are leveraged, meaning small movements in the underlying stock price can cause large changes in the value of the option. On the flip side, options also have something called time decay. This is the rate at which the value of an option will erode into its expiration. So every day that passes without a movement in the stock's price, the option becomes less valuable. This time decay accelerates as the option gets closer to its expiration date. Remember, options have a time value that decreases as the expiration date approaches, which can affect profitability. Start with learning. Understand the basics of options, the market, and strategies through courses and resources. Knowledge is key in this game, and there's an abundance of free and paid resources out there to help you build a solid foundation. From online courses, ebooks, to webinars, choose what fits best with your learning style. Next, get familiar with the market. Follow news and trends related to the Indian stock market and the global economy. The more you immerse yourself, the better you'll understand the market movements. Once you've got the theory down, it's time to get some hands-on experience. But don't rush into trading with real money just yet. Use simulation platforms to practice options trading. These platforms mimic real market conditions and allow you to trade with virtual money, giving you a safe space to make mistakes and learn from them. Use simulation platforms to practice options trading without real money. This helps you gain experience and confidence. Options trading offers unique opportunities but comes with its own set of risks. It's crucial to be well-informed and cautious. Today, we've navigated the basics of options trading in the Indian stock market. We've explored what options are, their benefits and risks, and how they function in India. We've also discussed key concepts like strike price and expiry, along with basic and advanced trading strategies. We've highlighted the volatility of options and the significant role time decay plays. And finally, we've shared some useful tips for beginners entering this thrilling yet complex world. This journey is just the beginning. The more you learn and practice, the more confident and skilled you'll become. If you found this exploration valuable, your likes, shares, and subscriptions can help us reach more people like you. Always remember to do your own research or consult with a financial advisor before making investment decisions. Happy trading!